One of the questions that I sometimes get is why I spend so much time talking about analyst estimates. Now the answer is simple. As an investor, one of the important factors that I consider when I'm looking for dividends is what the analyst estimates are going to be. And the reason is that these estimates provide me with some valuable insights about the future likely performance of this company. It's crucial for me as I begin to work out whether or not they're likely to continue to pay dividends. Now, nobody can predict the future with certainty, but if you've got a good grasp of future earnings and revenue expectations, it can help you to make a more informed decision, and that can also reduce some of your potential risks as an investor. Furthermore, the analyst's estimates actually also allow you to assess the overall market perception of the company's future prospects. If these estimates are positive and above the overall consensus, this suggests that the market has high expectations and could lead to an increase in stock price and, over time, also dividend payouts. On the other hand, if the estimates are below consensus and looking negative, it could be a red flag that we can use to assess carefully early on when we see it. Next, I'm going to delve into some of the important points here about analyst estimates when investing for dividends. I'm going to explain a little bit about what they are and how they're calculated, and also what they mean for me and how I use them in my investing. First, analysts' estimates give an indication of how the company is expected to perform into the future. Now, I'm an investor. I want to make the most of my dividend investments, and I understand that these estimates are going to help me to understand and evaluate the overall likely performance of the company into the future. The estimates give me valuable insights regarding their future earnings potential, and this in turn will suggest how much they'll be able to pay out in dividends to shareholders. Now, the analysts' estimates are usually based on quite a range of different factors. So this includes their overall past financial performance, general trends within the industry, and the overall market conditions. Furthermore, the operating earnings, which are a key factor for me in determining the dividend sustainability, are also going to be quite closely tied to these estimates. Simply put, keeping a finger on the pulse of the analyst estimates can help you to make an informed decision and enable you to maximize your returns in dividend investing. Analysts' estimates can also give you insight into the company's potential for further dividend growth. As an investor, I'm looking to build a diversified portfolio of dividend-paying stocks, and so I'm really interested in figuring out which companies have the potential for sustainable dividend growth with time. Now, one useful resource for assessing this is the overall estimates that are provided by industry analysts. So these industry analysts, again, they've looked at a range of different factors to develop their overall projections for the dividend increases into the future. By analysing the overall estimates, both for the company's financial performance and the overall macroeconomic conditions, it gives me some insight into the potential for the company's operating earnings to increase in the future, which is likely to in turn drive dividend growth. This type of information is really important for me in my personal investment decision-making process. It enables me to assess long-term sustainability of those dividends and really make a better choice about which companies I want in my dividend-focused portfolio. Analyst estimates can also suggest whether a company is overvalued or undervalued. Now, it's not just dividends that I'm interested in, because I'm also looking to buy companies that are currently undervalued. Dividends are obviously useful when they're distributed to shareholders as a source of income for shareholders, but it's not the only thing that's important to me. Analysts' estimates give insights into the likely future earnings potential, but it also, from this, helps me to understand and evaluate whether the company is undervalued or overvalued at the moment. So I'm not just investing for income, but I'm also looking for downside protection with a more undervalued firm, and also that long-term capital gains. When we begin to look at the price-to-earnings ratio, coupled with the estimated future earnings, it can help me to understand whether or not the stock is trading at a fair price, or whether or not it's undervalued. In this way, using analyst estimates alongside operating earnings is an important way for me to help with my dividend investing. The analyst estimates can also help us to decide which stocks we might wish to focus on when we are selecting our investments. The estimates give us insight into what is likely to happen to the future operating earnings of the company, as well as their dividend payouts. This information is useful when we're looking at the overall future growth of that company. When we look at the analyst estimates for different companies side by side, we then get a better picture of those financial projections, allowing us to select the stocks with better growth potential and more stability in the long term. So when I'm looking for investment decisions, yes, I do look at those consensus estimates for the company's future earnings. I begin to look at what this means compared to the company's historical earnings, and this helps me to decide whether or not the stock is worth investing in. Ultimately, this information is simply an aid to me as I begin to work through the stock selection process. The analyst's estimates also give us insight into the company's overall financial health and well-being. It's really important for us to be able to assess the overall financial health for the organisation, and I find this is a really useful point where having detailed analyst estimates can be a very valuable tool. They don't just look at operating earnings, but they also provide estimates on a range of other factors. Now, some of these factors they will only forecast out for several years, whereas other analysts will provide more long-term estimates. By examining these forecasts, we can get insight into the overall stability for the company, as well as any likely risks into the future. For example, if the analysts are suggesting that there's going to be a large amount of capital expenditure at a time when interest rates are rising, this could suggest some risks for us to look out for. Analysts' estimates can also provide us with an oversight into the overall company risk profile. The analysts are usually focused on particular industries, and so they have a really deep understanding of what drives, what moves, and what shakes that particular industry. This enables them to assess the overall competitiveness of those key companies within the industry, but also begin to look at the overall trends and changes that might influence the company's success into the future. This allows us to generally have a sense of whether or not these trends are something that we should be concerned about, and perhaps whether or not the entire industry is one that we might want to step away from for a while, until later on in the market cycles. Overall though, analyst estimates are just estimates though, and that's also something that we do need to keep in mind. Analyst estimates can be tracked for overall accuracy. Websites like TipRanks provides you with some insight into the overall accuracy of analysts. Other companies like FastGraphs enables you to assess the overall accuracy of the analysts' projections into the future based on how they've performed into the past. Together, these enable us to assess whether or not this is a company where we're likely to be successful in relying on the analyst expectations. Now, some industries are just going to be inherently more tricky and difficult to forecast, where there's more cyclicality or there's more swings and volatility. On the other hand, other companies operate in more stable industries, and they have far more stable operating performance. In many cases, these companies are able to provide very good guidance also to the analysts and to the markets about what is going on and what the likely future scenarios are going to be. Wrap this together and you'll find that some companies are naturally more able to be analysed using the analyst's expectations, whereas other companies, the analyst's expectations are almost useless. And this is one of the reasons that I do use the charts on FastGraphs to really get a sense for the overall analyst accuracy when estimating these factors. Analysts also provide a range of their estimates that change over time, and every now and then they update their overall assessment of the company. Now what this enables me to do is I can begin to both look at when their estimates are changing and how much they change, and that can give me a sense of the impending overall changes to the company's likely prospects for the future. And so those analyst estimates and their shifts can give me an early warning sign about what's going on and what I should be looking for. Furthermore, even as I'm beginning to look at an investment opportunity, I can look at both the analyst estimates as well as my own assessment of the company, and from this I can begin to see if there's a divergence or if indeed there is some congruence between our expectations. When there's congruence, I usually have a little bit more confidence on top of my own analysis that I'm on the right side of the expectations here, particularly when I have an agreement with analysts that know this company and know this industry better than I do. Long term, as I'm looking at my investment portfolio, I can simply keep an eye on these analyst estimates and use those trends in the analyst estimates to also gauge whether or not the company's prospects are likely to be changing rapidly. And that enables me to red flag issues that I need to pick up on and investigate further. Analyst estimates are not some type of panacea, they are not a silver bullet. There's multiple reasons for this. Small companies often do not have a lot of analyst coverage. Also, analyst estimates often do not extend very far into the future. So as a long-term investor, I'm not able to get a very good sense about those long-term growth prospects from an analyst's estimate. Usually. Some analysts do provide longer-term estimates, and others do not. But even when we're thinking about what a long-term estimate is, it could range anywhere from about 3 to 5 years, but they usually get reported in terms of an overall compound annual growth rate, or CAGR, over that period. We can begin to use these estimates and those revisions as they get published to the market to get a sense for what those long-term growth prospects are for the companies. Absolutely. Analyst estimates are not the be-all and end-all of my analysis, but I absolutely do keep a close eye on them, often looking at quite detailed analyst expectations for the different items when I'm looking at the overall financial health and prospects for a company. It's not going to be the same for everybody, and as I've suggested, it's not going to be particularly useful for all of the companies that I invest in and all of the companies that I look at, but they can provide quite a useful line in the sand for me as I begin to evaluate the options. Hit me up in the comments below. What do you think? How much do you rely on analyst estimates, and what sort of analyst estimates do you find most useful for which companies? Let me know. Let's get into it.